Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Union Pacific Corporation Annual Report. Union Pacific Corporation offers a diverse range of transportation services to various industries across the United States. At its core, the company provides rail transportation for a multitude of goods, including grain and grain products, fertilizers, food and refrigerated products, coal and renewables. In addition to these primary services, Union Pacific also transports construction materials, industrial chemicals, plastics, forest products, specialized products, metals and ores, petroleum, liquid petroleum gases, soda ash, and sand. The company's transportation network extends to finished automobiles, automotive parts, and merchandise in intermodal containers. Furthermore, Union Pacific caters to specific industries such as grain processors, animal feeders, ethanol and renewable biofuel producers, and construction companies. Its extensive services enable the efficient movement of goods across the country, supporting various sectors of the economy. Unfortunately, I do not have access to the extracted summary. However, I can provide a general overview essay on what may cause a stock price to increase. The stock price of Union Pacific Corp has increased slightly over the past year due to several factors. One major reason is the company's strong financial performance. As one of the largest railroads in North America, Union Pacific has been able to maintain its market share and increase revenue through efficient operations and strategic investments. This financial stability has led to a rise in investor confidence, causing the stock price to appreciate. Another factor contributing to the increase in stock price is the company's focus on innovation and technology. Union Pacific has been investing heavily in digitalization and automation of its rail network, which has improved efficiency and reduced costs. This forward-thinking approach has enabled the company to stay ahead of competitors and maintain its position as a leader in the industry. Additionally, the growing demand for freight transportation services has also contributed to the increase in stock price. As the economy continues to grow, companies are looking for reliable and efficient ways to transport goods, making Union Pacific's rail network an attractive option. The company's ability to meet this increasing demand has led to higher revenue and profitability, further boosting investor confidence. Overall, the combination of strong financial performance, innovative approach, and growing demand for freight transportation services have all contributed to the slight increase in Union Pacific Corp stock price over the past year. Union Pacific Corporation maintains a market capitalization of $150 billion, broadly in line with the industry peer group. Union Pacific Corporation trades at a higher price-to-earnings ratio of 21 times and a higher price-to-book ratio of 8.11 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 75% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 2.19%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth and decline are multifaceted and influenced by various market trends and external factors. Revenue growth is primarily driven by the bulk segment, which includes grain markets, fertilizer movements, and coal shipments. The industrial segment also contributes significantly to revenue growth, with commercial, residential, and governmental infrastructure investments driving demand for steel, aggregates, cement, and wood products. Additionally, international business through West Coast ports and inland intermodal terminals, as well as core pricing gains and volume increases, contribute to revenue growth. On the other hand, revenue decline is primarily driven by weaker demand for automotive and energy markets, lower fuel surcharge revenues, and negative business mix from reduced automotive shipments. The premium segment also experiences a decline in volumes, contributing to overall revenue decline. External factors such as tariffs on imported goods, changes in trade agreements or policies, and consolidations or mergers in the steel industry can impact revenue growth or decline. Government incentives encouraging alternative energy sources and changes in consumer preferences for goods or services related to alternative energy and emissions reductions can also have a positive impact on revenue growth. However, compliance with laws or regulations related to climate change, pandemics or public health crises, fuel prices, capital markets instability, and mergers and acquisitions can negatively impact revenue growth. The net income of a company experienced fluctuations over the years due to various factors. Initially, it decreased due to increased litigation costs, environmental liabilities, and potential costs related to climate change and pandemics. However, by 2025, the net income saw an increase of 8% compared to 2024, with a significant rise of $391 million, 6% increase. The net income also rose from $6,747 million in 2024 to $7,138 million in 2025. The profit margins of the company also underwent changes. Initially, they decreased due to competition and potential improvements or expenditures in alternative modes of transportation. Additionally, significant cost increases from restrictions on emissions, government regulation, and changes in consumer preferences for alternative energy sources contributed to the decline in profit margins. However, despite these challenges, the operating income margin improved slightly from 37.6% in 2023 to 40.1% in 2025. The net income margin also saw a modest increase from 26.4% in 2023 to 29.2% in 2025. The company's financial performance indicates a strong ability to generate cash from its core operations. According to various sections of the report, the company has consistently produced positive operating cash flow in recent years. On page 28, it is stated that the company generated $9.3 billion in cash provided by operating activities in 2025. This figure is also reflected on page 36, where it is listed as $9,290 million for the same year. Furthermore, page 49 confirms that the company is indeed generating positive operating cash flow, with specific amounts listed for each year. Additionally, page 56 provides a more detailed breakdown of the company's operating cash flow, showing a figure of $1,280 million in 2025. These multiple confirmations demonstrate the company's ability to generate significant cash from its core operations, indicating a strong financial position and potential for future growth. The company's debt level has experienced fluctuations over the years. Initially, it was expected to increase significantly due to new indebtedness incurred in connection with mergers. However, subsequent reports indicate a decrease of $765 million from 2023 to 2025, followed by an increase to $63.5 billion as of December 31, 2025. The total debt also increased from $30,192 million in 2024 to $31,814 million in 2025. Regarding interest expenses, the company has seen varying trends. While some reports suggest a 3% increase and an increase by $51 million from 2024 to 2025, others indicate no significant change or even a decrease of $8 million from 2023 to 2024, and further decreased to $3 million in 2025. The interest expenses have remained relatively stable, with some minor fluctuations between $1,269 million and $1,309 million over the years. Management is emphasizing a multifaceted approach to drive growth and success. The company's strategy centers around three key pillars: safety, service, and operational excellence. This approach aims to lead to long-term benefits through significant investments in capital, which will harden infrastructure, modernize equipment, and embed new technologies. The company has a strong presence in the U.S. market, with a vast network of route miles connecting major ports and gateways. Management is focused on serving key markets such as grain, fertilizer, coal, industrial chemicals, plastics, and automotive parts. Employee retention and quality of life are also prioritized through investments in technology and innovative safety and security initiatives. The company's commitment to safety is evident in its focus on 4 pillars, reinforcing critical tasks, and using technology and data to identify and mitigate risks. Service delivery is also a key area of focus, with performance measured against best results over the last 3 years and engagement with customers through innovation and growth. Management expects to achieve synergies, cost savings, innovation, and operational efficiencies from the merger. The company will continue to transform its railroad using technology and automation to improve service product, resource utilization, and lower overall cost structure. With a focus on improving network fluidity, freight car velocity has increased by 8%, locomotive productivity improved by 3%, and train length increased by 2%. Overall, management is confident in the company's ability to drive growth and success through its strategic approach, investments in capital, and commitment to safety and service. The company has made several significant acquisitions and divestitures in recent times. In terms of acquisitions, the company is currently involved in a pending acquisition of Norfolk Southern, with multiple references to this deal scattered throughout the financial statements. This suggests that the acquisition is a major priority for the company. In addition to the Norfolk Southern acquisition, there are no other notable acquisitions mentioned in the extracted summaries. However, it's worth noting that the mergers with Norfolk Southern are subject to certain conditions and are pending approval. On the divestiture side, the company has sold its commuter operations to Metra, another subsidiary, which is expected to generate revenue for the company. Additionally, the company has also recorded a gain on the sale of intermodal equipment, although the exact amount is not specified in the summaries. Overall, while the acquisitions are focused primarily on the Norfolk Southern deal, the divestitures have been more varied and include both the transfer of commuter operations and the sale of intermodal equipment. The company's financial activities have been marked by a commitment to shareholder value. One key aspect of this is the payment of dividends, which has been a regular occurrence. The company has consistently distributed dividends to its shareholders, as evident from multiple references in the provided summary. In addition to dividend payments, the company has also engaged in share buybacks. This strategy allows the company to repurchase its own shares, thereby reducing the number of outstanding shares and potentially increasing earnings per share for remaining investors. The company's decision to engage in share buybacks demonstrates a focus on maximizing shareholder value through various means. There are concerns about inventory buildup and supply chain disruption in the company's operations. One potential vulnerability is related to petroleum and LPG shipments, which may be affected by refinery utilization rates, regional crude pricing differentials, pipeline capacity, and asphalt for road programs. Supply chain disruptions can arise from various causes, including supplier discontinuation, changes to trade agreements or policies, strikes or work stoppages by labor unions, and availability of qualified personnel. Additionally, government incentives encouraging alternative energy sources may also impact the supply chain. Furthermore, severe weather conditions, natural phenomena, pandemics, or public health crises can all contribute to disruptions. Lower fuel surcharge revenues due to lower fuel prices and weaker demand for automotive and energy shipments are also a concern. These factors can lead to inventory buildup and disrupt the company's supply chain, potentially affecting its operations and profitability. That concludes the financial summary for Union Pacific Corporation. Feel free to comment below, and I will be happy to answer them when possible.